Today, I want to talk about the dangers of options, shorts, and margins. Most small investors are immersing in the details of these trading system without asking what is really good for them. In fact, they are invented by the big players for the small players for a reason. What reason? Well, you can guess. Because when you play the options, shorts, and margins, your brokerage companies have all the records. By law, they are not allowed to share your private records, but they can add together all the options, shorts, and margins placed by the small players, and they come up with an aggregate number. And there's no law that prevents them from sharing the aggregate data with the other big players. Also remember that your brokerage companies may be big players themselves. So after they aggregate all these numbers, the big players can see all the small guys' bets in aggregate, not individual bets. Now, the big players, when they see these bets, they can take actions against the small players. They can take actions with regard to all the options placed, all the shorts placed, and all the margins placed. When the big players take actions every day against these bets, it often explains the short-term variations, ups and downs in the stock market. Now, let me talk about the dangers of options. Options means you don't have to pay the exact amount of cash to buy stocks. You are required to pay only a small percentage. So there's less cash required. So that sounds good, but there's a catch. That means you're encouraged to play more, to play a bigger bet. And in that way, you tend to play more and lose more. The danger about options is the requirement. There is a dual requirement. You've got to specify, first of all, the direction of the stock that you play, whether it's going up or going down. And also you have to specify a time limit. Let me tell you, this is hard. It is already very hard to specify the direction of a stock because you never know which direction it's going to go. And it's doubly hard if you have to impose yourself a time limit, like a month or 2 months. So if you are required to do these hard things, chances are you're going to lose, you're going to miss. And if you miss, the big players will win. Now the big players, all they need is to take a look at the big aggregate numbers, and then they act against the majority of the bets. That's how you win in a casino. You win the majority and you lose the minority. Dangers of shorts. Shorts are more dangerous than options because in the first place it is expensive. You only short a stock when it gets to a high price. You never short at a low price. So you got to short at a high price, and the other thing is that you got to pay interest. Because when you short, you got to pay your brokerage company a fee for borrowing the stocks for you. And so shorts are only meant for the short term, not for the long term. And the big players, of course, they know your bets because your records are in the accounts, and all they need to do is to total up the shorts placed by the small guys. And all they need is to go against the shorts. How to go against the shorts? Very easy. They just push up the price for a few days and scare the small guys into surrendering. Now we come to the dangers of margins. Margins means less cash required to buy stocks again. And if there's less required, you tend to play more, and then you tend to lose more. When you buy a stock on margin, you have to pay the interest on the margin loan because your stock broker is lending you the money to buy the stocks, and you have to pay interest on a daily basis. And the bad thing is that if you buy a stock on margin and when the stock comes down, you are subject to a margin call. Margin call means an immediate demand for cash. So you have to either put in the cash to cancel the margin call, or if you don't have enough cash, your broker will make you sell your stocks. That means you are subject to a forced sale. A forced sale is usually done when the price comes down. So playing margin is also a dangerous game because the big guys know the aggregate margin bets. All they need is to bring down the stock price for a little while and then get a lot of forced sale. Now, having talked about all the dangers, what is the safety? Of course, when you have enough cash, you have a lot of safety. If you use cash to buy stocks, you limit the amount of your bet. You only go as far as your cash allows. And if you use cash, you can buy and hold as long as you wish. You are not subject to any requirements. And also you can sell whenever you wish. You can even sell on the same day if the stock goes up significantly on that day. If you play cash, even your records rest with the stockbroker. The big players cannot know your bets. They don't know your intention because you can hold them and sell them when you want. That means you are keeping them guessing all the time. You keep your opponents guessing all the time. And this is the good way, the best way, in fact, to play a game.